Good morning from London. I'm Kriti Gupta alongside Guy Jonsson and Rebecca Chung-Wilkins. This morning, we're an hour away from the opening trade. Here's what you need to know. The U.S. House of Representatives passed a multi-trillion-dollar bill extending tax cuts and allocating billions of dollars to defense, now facing hardliners in the Senate. And G7 nations pledged to address, quote, excessive imbalances in the global economy, calling for an analysis of market concentration, supply chain resilience, and risks of international low-value shipments, often associated with Chinese retailers. And the Trump administration blocking Harvard University from enrolling international students, delivering a major blow to the school and escalating its fight with elite colleges to unprecedented levels. Investors bracing for asset sales from the endowment. Guy.
As far as I can tell, the market's already decided, Kriti, that the long weekend has started. There is nothing going on from a market perspective. I'm sure we'll find some things as we work our way through the show towards the European Open. But Euro Stoxx futures are absolutely becalmed, as are E-mini futures over in the United States. We've had this turbulent week, but super calm this Friday. 30-year yield, yeah, we're selling off a little bit, but not by much. Is that a green light, basically, for the US government to spend more? The dollar, a little bit off this morning. Euro dollar trading 113.25. We're going to find some exciting news over the next couple of hours. There are plenty of things to talk about. We'll get to that in just a moment. The countdown to the opening trade starts right now. Good morning, good Friday morning. It is a long weekend. That is what beckons in prospect. As far as I can tell, it has already started. There's very little going on from a market perspective. We'll kick around what the week has done, though, in terms of the trading story in just a moment. But we are heading into a long weekend. It is fairly quiet out of there. But none of that matters this morning because Rebecca Chung-Wilkins joins us this morning.
I knew that was the setup coming.
Of course.
All the news you need. I mean, I have to say, I was looking at this week really hoping for a punchy, busy, volatile end to the week. It's much quieter than we thought, but...
I can't work out if this is a good thing or a bad thing from your point of view. Joining us...
It's always a bad thing, right? We always want to see some kind of ripples. And I have to say, the bond story, I've been surprised. It's been much smoother than I thought. I thought this was going to be a tougher ride. I'm kind of astonished in a way. And even the reaction in markets, when we're looking at bond markets today.
Yeah. Val has spent the whole morning, Valerie Teitel spent the whole morning telling me how this is such a bullish setup. That the bond market story is basically giving the green light for America to spend, and it is going to be a repeat of the COVID story that the US economy is going to accelerate. In some ways, you can see that story. I'm a British guy with a kind of bearish attitude, as I've had the Mickey taken out of me this morning. But you can kind of see that argument being made.
Well, from whatever the opposite is of a British guy with a bearish attitude, this is a key point that she's making, is simply that there was such a fear factor of what if these tax cuts from a domestic policy point don't actually come through. The marginal increase in what some of these consumers were paying would have been enormous, to the point that in itself, take out the kind of bond market story for a moment, from a consumer resilience story, would have been quite the hit if we're talking about something that is perhaps a little bit more punishing to the end consumer. But this was interesting because they're also talking about allocating, again, to defense, pulling away from Medicare, pulling away from some of the energy, renewable energy tax credits as well, but leading into the defense story, leading tax cuts. This is not a done deal, though. This is still has to go to the Senate.
Well, there is also this story. I mean, we've seen this shift away from this being a geo-economic story, a story about tariffs, to this fiscal story on the US side. But I normally sit in Hong Kong. I want to bring a bit of that Asian perspective, which is really this question of where do these big Asian nations, holders of treasuries, China and Japan, these are the two big players here, where does this leave them, particularly when we think about who is going to be buying all of this debt down the line as well? And there has been this question mark. Do they have leverage in their trade negotiations, in their trade deals? So I think from that perspective, from the Asian perspective, this really still is. There's a strong geo-economic element here for governments watching at how this is playing out.
You've also got a Japanese bond market that is now throwing out the option of actually staying at home, which is interesting. Yields are starting to climb higher. Simon White wrote a great piece yesterday talking about the risks surrounding what is happening in the bond market in Japan and just how big it is and how that could filter around the world. So this is a double-edged sword here that we're talking about when it comes to bond markets both in the US and in Asia.
Look, we could talk about this for a long time. There is a lot of soul-searching going on in my part of the world about so-called reverse Asian financial crisis. What does this mean if we see capital coming home? For sort of 2-3 decades now, Asia's model has been built on this notion of investing outside, investing in the US. We just haven't seen this, ever reverse since 1997. Now suddenly this capital is coming home. Is there enough liquidity? We don't know.
And I think that argument creating a floor to some extent in the bond yield story. But let's talk about what's creating a ceiling, and that might just be the trade concerns and potential growth concerns off the back of it. We didn't get a ton of that out of the G7,
The G7, basically, the G7 decided clearly, I think finance ministers put their fingers in their ears and went, la, 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 don't want to talk about it. We're going to gloss over the big issues. We're not going to talk about what is going on in terms of the trade narrative. They talked about excessive imbalances. Sure, that's great language, but it doesn't really take us further forward. I can't work out whether they just basically don't have anything to say, or whether or not it's such a sensitive subject they don't want to say anything. And I think that could be an important distinction at this point. Some of these negotiations are quite interesting sort of points. So do you really want to kind of get into it at a meeting like this? I did think, though, the stuff on Ukraine was interesting.
Yeah.
And the fact that the US went along with the communique that was signed that was quite strong on the Ukraine story. And you do wonder whether the Trump administration is tacitly giving acceptance now for the fact that we are going to see further sanctions. I don't know what those are going to look like. Is it going to be the Graham bill that's coming out of Washington, further sanctions coming from the United States? But it does seem as if we're now moving in that direction. So I think that's something that markets have got to calculate and figure out now, is what the next set of sanctions is going to look like and how strong they'll be with US backing. And I think that's something that I think the G7 communique kind of hints at.
And this comes off the heels, of course, of, I believe it was the Wall Street Journal reporting, which Donald Trump had privately suggested to some of the European leaders that this was a done deal and that he was going to back out, and that Vladimir Putin not interested in ending the war. The other point of consensus, and you hinted at this at the start, was that take on Asia as well, where they didn't outright say China to begin with, but they did talk about a lot of the issues that we know China is more exposed to. Rebecca, I'm curious, just from your perspective, how are the Asians probably feeling about that?
Well, look, I think this does really matter. It is, to Guy's point, it is very general, vague language, but I think Beijing is looking at that very, very closely. And I would say it's likely that it's less important that it's coming out of perhaps of a Scott Bessent and that sign-off. It's more important that it's coming out of European countries, because that's where China really is trying to reinstate this great economic reset here. That is where you really want to see them trying to offset and blunt the impact of US tariffs. It's the Europeans. And to be frank, trade officials in Brussels have not really been receptive to this narrative. Chinese have struggled to get over this idea of the overcapacity, the subsidy narrative, even as they try and pitch themselves as the alternative to the US, as this bastion of free and open trade.
You need to have a consumer, though, to back that up, and that is where the challenge really lies for China at the moment. Still struggling. You see in the data kind of almost every day that we are still struggling with a consumer that can't get on the front foot, that can't kind of get out there and spend, despite all of the subsidies and pushing that is being delivered coming out of Beijing. Let's talk about Harvard. Let's talk about Harvard. I don't know how you make that segue, but it is the story that everybody's talking about this morning. And I think, Conni, you came up with a really interesting line on this, which is basically that we find ourselves in a situation where Harvard is under severe pressure. But what are the financial ramifications of this? What happens with the endowment? Private equity, we're going to hear from a conversation that you had with EQT yesterday. How does the endowment story, which is now going to be under significant pressure, given the fact that foreign students are a key source of revenue for Harvard and other universities, how does that affect the financial story?
Key source of revenue from tuition, but also from alumni contributions and the network that's built off of that. Not to mention several Harvard alum who've become world leaders and CEOs of companies around the world. But yeah, this is the world's largest endowment, and suddenly, if they do get that cash crunch, they're going to be hitting the asset sales market very quickly. Private equity is a key piece of that. We've already seen Yale kind of do it defensively instead of looking at seeing what's happening at Harvard, saying it might happen to them, and doing it defensively. But I want to point out to our international audience here, Rebecca is guest hosting today. You're also a Harvard alum, and you've also were an international student. So I'm just curious from your perspective. I mean, you speak to, I'm sure, several people in the alumni network as well. What's your take?
Yes, I did go to that school in Boston, no, my phone has been blowing up, really, I have to say, really since yesterday evening here in London. Real uncertainty and question marks. By coincidence, I was there last month already speaking to international students who are deeply anxiety, rethinking plans about staying in the US and rethinking plans about even just going home over the summer vacation. They're just planning to
because they're worried about getting back in.
Exactly. So this was already a real issue. Essentially, they're just staying all the way 2 years, for example. These were MBA students. They're just not going to risk it. There's so much uncertainty. But to that point about the debt story and the alumni donation story, historically, of course, we have seen some Harvard alumni coming out reacting to this kind of targeting, trying to sort of put their money where their mouth is. It, of course, is really not going to compare if we see that kind of crash crunch that Kriti is talking about. But it's not just a Harvard story. We think about the Yale raising debt earlier this year. There's a whole bunch of these, Ivy League institutions that are considering and figuring out, how do we come to market? Is it debt? Is it private markets? How do we create that buffer? Harvard is not alone here. It's just a warning signal for the whole host of institutions worried about the same thing.
Do you have to do that as a Harvard alum? Do you have to kind of point the finger at Yale and kind of just say it's like...
They make you take an oath at the gates, right?
I'm not here to make enemies. I can see that's what you're trying to have me do.
No, but she's got a key point. Harvard, Yale, Columbia, these are endowments that are sitting on billions and altogether over, trillions that we're talking about. And they're actively exposed to long-duration assets. And that's where the private capital story is. But it's also where the bond market story is. That's where the sell-off is as well. So if you start to see that liquidation, this endowment story really only amplifies some of the stress you're already seeing in those long-dated assets anyway. So that's going to be a key piece that we watch out for and listen to as well. Plenty to talk about on the show. Even though it is kind of a quiet market today, as Guy was saying, bracing for the long weekend, we still have an all-star lineup for you on the show today. Bettina Mazzocchi, BlackRock EMEA Wealth Solutions co-head, will be joining the program shortly, as will Ella Hoxha, Newton fixed income head, also on this bond market and perhaps some of those longer-dated assets that we were just talking about. And then, pleased to say, right at the European Open, Christian Mueller-Glissmann, the Goldman Sachs asset allocation research head. Do we see a real change in sentiment? Is American exceptionalism perhaps back on the table, or is it European exceptionalism here to stay now? And then we're going to talk about the trade story that's looming over all of this. Vivek Ramachandran, HSBC's Global Trade Solutions head, also joining the program.
Some great guests lined up alongside Rebecca throughout the entire show. Let's talk about what else you need to know this morning. Bloomberg has learned that Apple is looking to release a pair of smart glasses by the end of next year in a challenge, of course, to rival Meta's Ray-Bans. Sources say the glasses would have cameras, microphones and speakers and handle tasks such as phone calls, music playback and live translations. Meanwhile, Apple has shut down work on camera-equipped Apple Watch, but is still looking apparently at AirPods with cameras. We need to come back to AirPods with camera. Why? Do I need to see the side of... Anyway, we'll come back and talk about that in just a moment. OnlyFans owner Phoenix International is reportedly in talks to sell the company to an investor group at a valuation of around $8 billion. Reuters cites anonymous sources saying the owner is also considering an IPO and is fielding interest from other suitors. And the US Supreme Court has shielded the Fed from President Trump's push to oust top officials at independent agencies. The court ruled the Fed is a uniquely structured quasi-private entity. The decision is likely to quell concerns, for now at least, that the president might move to fire Jerome Powell, but the top court upheld Trump's powers to fire leaders from other agencies. So Powell is safe for now, but I thought we'd moved on from this. The Supreme Court is basically backing up the reality. I think the Trump administration had basically already got to the point where it assumed that it probably would struggle to fire Powell, which is why the president backed down quite quickly on this subject.
But there was always the risk that they would change their minds. And now
there's always that risk.
Right. So now they legally can't do it, as opposed to simply saying they don't want to do it, which I think is
the pressure from the bond market was also there as well, which I think probably...
Absolutely. But I think Chair Powell's term ends next year, 2026, so we're not far away from a change.
Well, they're talking about the autumn as being the time when they start the interview process, basically.
But it's the pace of this decision as well, and it's how it's emerged and how it's evolved. To your point, that it could have been a much longer, more painful sort of process had the Trump administration kicked up more of a fuss.
Should we talk about why you would need cameras in AirPods?
You really want to talk about it, so go for it.
I don't understand why you would need cameras in AirPods. The glasses I get, because you're kind of looking forwards, but even these glasses don't actually change what you see, I'm assuming.
But is the camera on the inside of the AirPod or like on the outside?
Why would it be on the inside?
Presumably it's on the outside.
Well, that's what I don't understand your line of questioning.
But what am I... What's it connecting to? Is it sort of forward-facing cameras? But that's what
we're going to hook you up with Tim Cook, and he'll answer all those questions.
You'll be able to sit here and see a 360 all at one go.
But through my glasses, are they going to connect with the glasses?
Yeah. No need to turn your head anymore, Guy. That's the surplus to requirements. Just straight on only.
Straight on only. Just look at the camera. Don't just kind of look forwards. Anyway, precisely. And as they're pointing out in my ear, which is where I hear, that you could ultimately just have auto cue. We don't need cameras anymore. We'll just have auto cue in our glasses, and we'll just Perfect.
We're moving ahead with the times here, guys. We've actually reorganised this entire show just in 2 minutes.
Just it, precisely. There we go. Job done. Moving on.
It's a Guy Jonsson specialty, I have to say. Coming up on the program, we're going to dive into all the details we were just talking about. Maybe not so much on the Apple AirPods story, but the rest very much important. We're going to bring you an exclusive conversation with the Swedish billionaire and founder of the biggest European private equity player in Europe, EQT. That conversation coming up throughout the show. Plus, we'll get the latest on the White House's ban on Harvard's international students as many alumni wake up to the news around the world. But up next, right back to the markets. Will the calm after the passing of President Trump's tax bill persist? We're also going into a long weekend, something to factor into your thinking today. If you have any questions of your own or for our guests get involved in the conversation, IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Percent is a dip, 10% is a correction, 20% is a bear market. That's kind of the way we talk about it. So we do think a 5% correction or dip is possible based on the move in rates. That's kind of been our view. And quite frankly, we're still stuck in that range that we identified earlier this year, 5,500 to 6,100. So we got closer to the upper end of the range. Now we're going to get a dip. I'd be surprised if we take out the 5,500 unless something really, deteriorates again on the tariff side.
Still struggling, Mike Wilson being so positive. Anyway, Morgan Stanley's Mike Wilson on his call on the US equity market to remain range-bound this year, and that's positive. Valerie has a really upbeat view on the world this morning, so let's talk to her.
Oh, guys, setting me up well. Feeling bullish on this Friday, and really it's all down to this government spending. The fact that the bond market has almost just allowed Washington to continue spending when already the deficits are at historic wides. I've got a chart behind me of the U.S. fiscal deficit going all the way back to 1970. Yes, we juiced the economy during COVID, the most we've ever seen it, but we are still at historically wide levels, and this bill passed by the House, paving the way for it to go to the Senate, just means that government spending is going to be there and going to be present. Will that be enough to juice the economy and perhaps, break out to the top side in the S&P 500? Take a look at this chart. This is another one I want to pick out. This is the Bloomberg survey of economists for their 2025 forecast for U.S. GDP. We've now turned a corner, Guy. It's its first upward revision since the tariff fallout, and I think this just goes to show we are feeling a bit more bullish on the U.S. economy, and I'm feeling a bit bullish on the equity market this morning.
Yeah, earlier this week I was accused of having a British accent and being bearish, like tacitly, but I was definitely accused of that. Valerie takes the opposite side of that trade. Bettina Mazzocchi, head of co-head EMEA Wealth Solutions at BlackRock, joining us now. Mazzocchi, sorry, I mispronounced that terribly. Anyway,
Mazzocchi,
Bettina, nice to see you this
Good morning.
I'm terribly sorry. I'll get it right next time when I say thank you, but I think Critty's doing that. How are you feeling about equities this morning? How should we be feeling about the world? Valerie's setting us up for a much more positive view of how we should work our way forward from here. The bond market's actually okay with higher fiscal spending out of the United States. That's going to juice an economy, and it's going to juice, therefore, equities. Should we be more positive on equities right now?
So before we look at equities and fixed income, which have both seen quite a bit of swings recently, let's step back to take stock of what we've learned about policy and markets year to date. And it's been quite a remarkable year, really. One, a bit of a roller coaster with policy firmly in the driving seat. And overall, we don't think that uncertainty ends here. So there is a lot of uncertainty and unpredictability, both in fixed income and equity market. But in this fog, what we've taken away from the beginning of the year is really that we have economic guardrails. One of them is that supply chain can't be reinvented overnight without real disruption. And that is what the 90-day tariff pause quietly acknowledged. Moody's decision to downgrade the U.S. credit rating shines the light on another such rule. Keeping U.S. debt sustainable relies on steady and large funding by foreign investors. So policy can shape the market, but economic reality remains really the ultimate policymaking compass.
So we should expect more volatility, right?
So there has been volatility for sure. we've seen some easing in market tension around tariffs. Focus has now shifted towards U.S. fiscal outlook. However, we think even on the tariff volatility-driven, the story is far from over. What has really driven market volatility so far is policy uncertainty. Looking ahead, the impact of these tariffs on the economy is still to come. So talking about volatility, we continue to believe that tariff will drive up inflation and weigh on growth, potentially even with recession-like effects in the coming quarter. But it's important to note that this would be a technical recession, not a fully fledged business recession, and U.S. companies are starting from a position of strength and remain relatively resilient. So in the near term, we're closely watching two key factors, progress on trade deals and the extent to which supply chain may be disrupted, and we see those as two big drivers to volatility in the market.
Bettina, I mean, you're talking about this shift in focus from investors away from that tariff story, perhaps, and that policy uncertainty as an overhang versus more focus on the U.S. fiscal story. I wonder, where do you see that disconnect showing up in markets? Do you think there is some area where there might be a mispricing or an underestimation of those longer-term impacts? It speaks to your point about volatility here and where we're going to see it come up.
So, very good question. Long-term U.S. Treasury yields are climbing on worries about growing fiscal deficit. The budget reconciliation bill passing by the House has added to those concerns. What was once seen as a boost for equities has a much more uncertain impact if looked at through the lens of debt sustainability and higher bond yields. So, from our standpoint, high level in our portfolios, we remain. I would say, if we look at the big three areas of our portfolio implication, we stay invested in equities despite the uncertain outlook, both in the U.S. on the back of the AI megaforce and outside of the U.S. on renewed momentum. We underweight duration with a steepening bias, which is a position we've had since the beginning of the year, on the back of fiscal instability and still a challenging growth versus inflation trade-off. But importantly, to your point, we pay particular attention to portfolio diversifiers as we seek to provide a reliable portfolio ballast in the current environment.
Bettina, I'm putting you on the spot here. Talk to us a little bit about what the hedge in this environment looks like and the liquidity. If we're talking about trying to be agile and trying to diversify, as you put it, what's the easy, go-to, cheap hedge here?
I don't know about easy and go-to, but certainly we've spent a lot of time on that topic, on building resilience alongside risk-taking. Let's agree that fiscal largesse is unambiguously negative for long-dated government bond, and fixed income, therefore, can no longer provide a reliable ballast to portfolio that it has in the past. So we look at other diversifiers. We recently have added, I can take two examples. We've recently have added to our portfolios a world minimum volatility position. Our regime analysis suggests that min-vol equity should fare better than either equal or market cap weighted ones, thanks to lower beta negative sensitivity to rate. Another one is private market. Private market is an interesting diversifier because it can provide early access to the structural mega forces reshaping the economy and
absolutely
offer a differentiated risk profile than public equities.
Bettina Mazzocchi, co-head of EMEA Wealth Solutions at BlackRock, joining us around the table this morning. We're going to continue the conversation that she was leading there on the market. Stick with us. This is Bloomberg. 30 minutes away from the start of the opening trade. Futures are pointing slightly downwards. I'm looking at U.S. futures here that are down about 0.1%. Your stock 50 futures unchanged, and CAC 40 as well. But if there is an outperformer, it's the FTSE 100. Already marginal moves from the get-go. It's a quiet day.
That's our performance, is it? That's what we're looking at here.
Relative to the red on the screen.
Okay.
Come on.
Small movements. It's Friday. We'll take that little small movement. Let's turn to the bond market for excitement or not. Anyway, we're seeing a little bit of a bid back into the bond market here in Europe this morning. 10-year treasuries are absolutely flat as a pancake right now. There's nothing happening there, but a little bit back into the 10 years this morning. Not much. It's been a fairly turbulent week, and that has obviously been something that we've been watching very, very carefully as the bond market has rippled out. The effects of the bond market has rippled out into other stories as well. President Trump's tax bill sending ripples through the bond market this week. Has it really, though, is the question that I think Valerie Teitel is here to answer. So everybody's got very excited about the 30-year, Valerie, but how much has it really moved?
Well, I've got a chart behind me, Guy, to your point of the 30-year yield in the last 5 sessions. So just this week, we're only 9.25 basis points higher on the week in the last 5 sessions. We really failed to break out to new cycle highs yesterday. And to me, I think that was just a key of this. The bond market is very much absorbing this tax bill decently well. So 503 is where we are on the U.S. 30-year yield. I want to show you a chart, though, of just the global pressure on long-end yields. This is a long-term view. This is going all the way back to 2000. You can see how this rapid rise in long-end yields, we've really kind of spiked this week. The one thing that really did spike was Japan. We've seen a 60 basis point surge in the 30-year yield in Japan in just the last 2 months, Guy. And I kind of want to argue the bull case from here. Let's say we get the Bank of Japan announcing maybe a reallocation to their QT tapering, allowing for more purchases in the long end. You combine that with the fact maybe from the U.S. administration, we get announcements on bank capital changes, the loosening of the reform, SLR reform, to allow U.S. banks to buy more treasuries. Those two things combined can really send us back to the year-to-date lows in long-end yields.
Certainly something we're going to be keeping a very close eye on. Bloomberg's Valerie Teitel walking us through some of those global yield dynamics. We thank you so much. Let's bring in another expert here around the program. Ella Hoxha, head of fixed income over at Newton Investment Management, joins the program. Ella, pleasure to have you. Valerie was just talking about this kind of I don't want to say hatred, but certainly dislike for the long end of the curve that you are seeing globally. How much of it is related to those deficit concerns in the States? How much of it is just wanting to be agile and moving to the front end of the curve?
Good morning, Kriti. Well, I mean, it's, as your charts are showing, actually, the move is being led particularly by Japan. You can see that we've broken above 2001 levels, and actually closely followed by gilts. So gilts have been playing this dynamic in the UK at the long end for quite some time now. So the market has been demanding a lot more premium to sort of lend to governments at the long end of the curve. So not necessarily a US isolated phenomenon, but of course, the budget bill that passed yesterday will add to those concerns in terms of supply and term premium, i.e. The extra yield that we're demanding to lend longer maturities. I think that phenomenon has been in play. So it's not necessarily just a recent event. And actually, if we go way back, so to pre-global financial crisis and even pre-2000 levels, you can build more term premium in curves, right? So you can build in some markets double the level of premium we have now. So, of course, we've moved a lot since the Fed cut rates in September. We've gone up 110 basis points, let's say, in the U.S. in the 10-year part of the curve. Can you build up more here? Absolutely, if this fiscal concerns remain alleviated.
The fiscal concerns you're talking about are ones that we've been talking about for years, though, when it comes to the budget, the deficit, even trade concerns as well. But, Ella, walk me through why the 10-year, really for the last couple of years, has been largely range-bound, looking somewhere between 4 and 460. Are we breaking out of those levels?
I mean, it's interesting because those types of levels have been more consistent with a soft landing narrative, which is what we've had from a macro cyclical point. But of course, we've had a couple of scare moments, right? So we had one in the summer, so end of July last year into September, and that caused that panic cut by the Fed, if you like, that 50 basis points. And then presto, we were immediately engaged with, should we be worried about inflationary dynamics? And then now in April, we also had that growth scare. So we've parked that aside for now, and we're back to fiscal. So bond markets are yo-yoing with this setup. And the reason is a structural one, right? So we gravitated to a higher interest rate, somewhat higher inflationary regime back in 2022. That regime is here to stay. It's a structural shift, right? And so I think for bonds, that setup has shifted us to the pre-global financial crisis levels. And so you can expect bond investors like ourselves, I suppose, to do their classic bond math and say, what should I be demanding to lend further out in the curve, particularly given what yield and premium you can get elsewhere in other assets. So look, I think that setup is here to stay. But in terms of this yo-yo, what breaks that? I think in terms of the growth scenario, for now, as I said, we've parked those concerns aside. The inflationary dynamics structure remain somewhat higher, right? So with that in mind, I think those are probably the two levers that will push us in another direction. The danger for now is that this fiscal phenomenon feeds on itself. And as I said earlier, if it's a global phenomenon and you're seeing yields at the long end go up, that should be somewhat of a concern, certainly for risky assets and certainly for policymakers as well, as they have to finance at much higher interest rates.
Yeah, Ella, I want to pick up on your point about risk there. And we think about the sort of global curve steepening that we're seeing. We're thinking about those fiscal pressures as well that you're mentioning. At what point, or is it the right moment to say that we are in a new regime where perhaps bonds become the primary risk signal? Is that even on the table at the moment?
Yes, I mean, we were speaking to Danny a fortnight or so ago, actually, in one of your programs, and it's exactly what we alluded to. So from January, equities were leading the charge in terms of driving sentiment in markets. And, it's very safe to say that now it's going to be rates, because much higher rates from here can disrupt the risk-on party that we've been enjoying since, say, early to mid-April. So absolutely watch those yields, watch the steepening premium. If those cannot be contained, I mean, you talked about this operation twist risks, or let's say QT shifts from the Bank of Japan. Those can shift the dynamics, right? Absolutely. But in terms of the pressure on yields and the demand for more premium, as I said, that's more structural and likely to stay with us for quite some time, I believe.
Yeah, I mean, so the other element here is this emerging market story, and you've talked about the sort of attraction for emerging market currencies. I wonder to what extent you see that as a structural shift, as a paradigm shift, or is this sort of there's a short-term momentum that's driving this that might run itself out here?
I mean, technically speaking, if you look at EM equities, EM rates, EM currencies, I think it's easy to make the argument that those assets are cheap. And we're also seeing some technical breaks and reversals in certain markets. It's not a story that's consistent everywhere. But what's interesting is lately, say, over the last 3 to 4 weeks, we've also had Asian currencies join that party as well. So I do think there is a structural argument for some appreciation of those currencies. Also, fundamentally speaking, some of those economies are actually ahead, and they've learned sort of the lesson of dealing with higher inflation, higher interest rates. So they've had to adapt to this regime some time ago. And so as investors, you're getting a lot of premium, in some cases above inflation, in terms of cash rates and in terms of double yields, and also quite a bit of carry on the table. So, of course, you have to do your homework. So it's not available everywhere. But I think you are at least getting paid some premium to own the risk there. And I do think over the next 2 to 5 years, the risk is that it's DM fiscal that becomes a concern, and DM currencies that are front and center of investors' minds. I mean, it's early days now, I agree, on EM, but actually we like the story structurally speaking.
Ella, good morning, it's Guy. When do we think we start talking about the Fed hiking rates, not cutting rates? You've got a fiscal expansion in the United States, potentially is going to juice the US economy. When do we put that back on the table?
Morning, Guy. I'm smiling because it's been, what we've called a roller coaster year, and it's very much yo-yo. We go from 100 bips of cuts to now talking hikes, and we did the same last year, if you recall. We started the year very bullishly on rates, and then we had quite a few swings and roundabouts. Look, I think it's a little early, and the reason for that is at least core inflation and some of the shorter-term inflationary dynamics remain contained for here. So that buys the Fed some time. So I don't think this is a case of starting to talk about Fed hikes. Of course, I think into next year, it's a very different story. That's the first element. The second element is, of course, we've got this fiscal package now that's coming in, so that should shelter things. But I think we're looking at growth, perhaps not recessionary-like, but still, on the sort of lower to positive side. So I think too early to talk about hikes. But this term premium element, this sort of build-up of yield that bond investors are demanding, that's an important dynamic because it just means that you're likely looking at a much higher interest rate path here. And I'm talking over the next few years, not over the next few months alone.
How does that, do you think, impact other central bank thinking, particularly the ECB? What happens there? Have we got one more and then we're done? Is that the kind of scenario we're looking at here? How does, again, this kind of higher yield story, particularly at the back end, impact central banks in Europe?
Well, the growth backdrop is a little less benign in Europe for now, and we saw it in the PMI numbers yesterday. Also, the inflationary dynamic is a bit better contained. The labor market dynamics have been different in Europe compared to, say, the US or the UK. So there are some sort of low-hanging fruit there. So it buys the ECB some time. Yeah, I think once beyond one cut to two cuts, you're sort of getting stretched. And I think bonds have kind of been repricing that story. And of course, we have this German fiscal package on the background as well. So I don't think that's completely safe in terms of repricing premiums. I do think it joins the global party, but on a relative basis, you should see some outperformance of European fixed income here relative certainly to the US, and we've been seeing that versus gilts as well in the UK.
Great to catch up. Happy Friday. Ella, thank you very much indeed for joining us. Ella Hoxha, Head of Fixed Income, joining us from Newton Investment Management. Stocks to watch next. Hexagon considering a multi-billion-dollar sale of its computer-aided engineering simulation software business, part of the Swedish firm's efforts to streamline its operations. We'll talk you through that story next. Stocks to watch coming up. This is Bloomberg.
I do think what is going on here is that the world understands that we are in a moment, that there is an imperative to getting access to this technology. The U.S. does have the innovation lead right now, and can the U.S. leverage this lead to bring our version of AI, a democratic version, to the rest of the world, and as part of that process, bring investments back to the U.S. as well?
That was OpenAI's Chief Global Affairs Officer speaking to Bloomberg after the company announced the expansion of its Stargate AI infrastructure program internationally. The company is partnering on a 5-gigawatt data center cluster near Abu Dhabi. For more, let's bring in Bloomberg's Tom McKenzie, who's been tracking this story. This looks like a land grab. Is that the right way of thinking at it? Get in there, secure everything, make sure that it's us that is doing it rather than anybody else.
On a physical basis, you're talking 10 square kilometres and five nuclear reactors that will be needed to power this. We don't know where that energy is going to come from. But in terms of the broader strategy of both OpenAI and the US government, of course, have given this their blessing, it is about making sure that the US, which has that front foot on innovation, can set the standards. That is the rationale from those who are pushing this. The US can set the standards by getting OpenAI in, along with Oracle, Cisco Systems, NVIDIA, bit of backing from SoftBank as well. So you look at it in terms of the software level, every single resident in the UAE will be signed up and given a free license to ChatGPT Plus as a result of this deal, and it's going to be integrated into government agencies as well. And so the proponents of this, including David Sachs, the AI tsar sitting within the Trump administration, say it's about making sure we lock in our lead at the hardware level and software level, because Huawei over in China is catching up with their own AI accelerators. The UAE is a neutral nation. They could lean towards China. This is closing that door and setting the standards for the US and giving them that opportunity with the UAE, which has on itself been on the front foot in terms of innovating around AI.
I mean, Tom, you've already brought up China there.
Yeah.
I want to ask how this sits with the China hawks in the Trump administration, but also this news that OpenAI is looking to expand data centers elsewhere in the Asia-Pacific.
So the two overlap, absolutely. Yeah. So the concerns from the China hawks are, one, you do not have an agreement, a commitment as a part of this investment deal that there will be no dispersion of this technology and that China will not be able to use these data centers. That could come because they're looking, the US and the UAE, to build out a deal on AI, and it's likely that those elements will be in the mix, but they're not there yet. That is a concern, no doubt, that China hawks will be pushing for. There's also just a concern more broadly. The UAE's alliances, they have tried to strike that neutral tone. If the politics changes, does that alliance still hold up, and to what extent will Chinese diplomatic pressure nibble at the edges of that? So they want to make sure that is contained, there's no dispersion. We've seen examples, reported examples of China using data centers outside of China in your region, Asia-Pacific, to train their models. Talking of which, AI executives or OpenAI executives will be on the ground in the Asia-Pacific region talking to South Korea, Japan, Australia and others about potentially building similar data centers, so expanding that Stargate project, again, in the Asia-Pacific region, which is already the densest home of data centers, because they see the potential in that region as well.
All right. Bloomberg's Tom McKenzie walking us through the OpenAI story and the global technology story. I have to say, he's given us a lot to think about. We thank you so much. Let's get a little bit more perspective on these markets here. It is a slow market today, but perhaps Mark Cudmore, our Markets Live executive editor, can rescue us from the calm. Mark, what do you make of it? What are markets missing? What do we need to be paying attention to as perhaps the next leg or the next signal or the next risk?
Good morning, Critty. I think one of the things that's really interesting is that everyone was getting very excited about the shipping from China to US a couple of weeks ago, in kind of late April, after the tariffs were imposed quite aggressively. And then everyone stopped watching those kind of trackers because we were seeing a little bit of a bounce back from extreme levels. Well, in fact, just this week, we've now seen fresh lows dipping in that terms of total laden tonnage going from China to the US. And I think this backs up the story that the real kind of tariff impact will be felt by consumers probably towards the very back end of May, maybe really into June, and maybe even the first couple of weeks of June, which means this shock from the US-China trade war is still coming, and it's still going to be really, really extreme. It's just hitting later than everyone thinks. So which means if it starts hitting consumers and the shelves in June, it means we may not really see the impact in hard data until we see it show up in the June data, which means we won't get those releases until July. So it's a very, very hard dynamic to trade. I think the long-term trends remain very clear, but short-term, we're waiting for the next catalyst.
I mean, talking about those data points that people are missing, Mark, I also noticed that shipments of smartphones, including Apple iPhones, from China into the US are down more than 70% in April, for example. So I want to ask about these points about this consumption story. Where are markets mispricing or underestimating that risk? Where should we be looking next?
Well, I think that in terms of where it's going to impact, I think that this is going to be most importantly, in fact, an inflation story, a yield story. And as we know, yields have been a focus already because the tax bill, the fiscal situation concern there. But I think you might suddenly get a much bigger inflationary impulse than people were expecting, because we've had some quite subdued inflation prints recently. I think people are misinterpreting the trend there. So I think that that's actually going to show up in a yield story next. So, you know, the US underperformance kind of trend has worked very well for the last few months. The initial leg was kind of stocks. The more sustained leg has been the dollar, and we talked about that earlier on this month. I think that the next leg might be maybe in June, July, might be more the yield side, the bond side. Okay. Well, underperforms. If they underperform enough, then it'll filter into stocks as well again.
Mark, how dangerous are JGBs right now?
I'm really worried by what's happening in JGBs, and I think the problem is it's a global situation. You know, that if they start having to repatriate serious amounts of money from around the rest of the world, that's going to exacerbate the upward pressure on yields everywhere else. So I think what people need to start watching the JGB market. You know, for kind of 20 years or so, I kind of ignored it. It was such a sleepy market. But the reality is that this is just such an immensely outsized market relative to the size of the GDP of Japan, that if these yields continue to go higher, we saw a high inflation print again this morning out of Japan, well, then that's going to feed through to bond markets everywhere. So to me, the real stress remains about the US Treasury market, but the fuse may be JGBs.
Yep. And has the fuse been lit? Mark, great stuff. Thank you very much indeed. Mark Cudmore joining us on what we're seeing around the world on the market story. Of course, if you want to follow Mark and the rest of the team, there's a simple way to do it. MLIV Go. on your Bloomberg terminal. Let's talk to Joe Easton about what equities we should be watching this Friday. What do you got your eyes on, Joe?
Morning, guys. So I've got my eye on AJ Bell, one of the UK's biggest investment managers, focused on the retail sector. Now, the company's saying in a statement that it's seen an uptick in the business due to the volatility spurred by tariffs in April and also March as well. So you saw a big jump in people coming online, looking for ways to trade that volatility, and that has helped their revenue beat expectations today. So that potentially is going to be a bit of a positive one. We can see that stock did actually drop down with the rest of the market, but then has rallied since, kind of outperformed. So potentially could be another positive one, maybe continuing that outperformance today. Then over in Sweden, we've got Hexagon. Now, this is actually a $30 billion company that doesn't really come on our radar too much, but it is a measurement firm with a decent market cap, looking to potentially spin off one of its units, one of the units that provides software for the aerospace business. This is according to an exclusive from the Bloomberg Deals team last night. Could be worth a couple of $2 billion according to the report. They paid around $800 million for the business, buying it from Elliott a few years ago. So that would be a decent return to keep an eye on Hexagon. We can see a bit of underperformance in that one, down around 19% over the past few years. Then we are over in tyres. Jefferies changing its preference on the big names there. They're upgrading Michelin, saying the company is exposed to the specialist tyre markets, which they say is the place to be at the moment. That is sold into aircrafts and also agriculture, that kind of thing. So they reckon that's where the tyre outperformance is going to come from. We can actually see the underperformance in Michelin and the outperformance for Continental recently. That one is downgraded to hold because the valuation has got a little bit too punchy. So the tyre changes on the radar in the ratings. Keep an eye on those ones at the open, Guy.
All right, Joe Easton, our equities reporter, walking us through some of those stocks to watch at the open. We thank you so much. The other thing we've got our eye on, of course, is the bond market. We are, I think, seeing European bonds open lower from a yield perspective, so getting a bid this morning. And so are the U.S. Treasury market as well. Just in the last few minutes, look at this. About 3 basis point move on the 10-year. Something to keep an eye on. You were, of course, watching the JGB story as well.
Absolutely. So we're watching what has been happening with Japan. That's been the story all week. I think it's Friday. I think probably the expectation is the market's maybe moved a little bit too much. I think you're just getting a little bit of money being taken off the table, big coming back in. People have been short that market. So I'm not surprised to see maybe this kind of move that we're seeing here this morning. But to Val's point, we are at a stage where actually the market's saying, actually, maybe we can live with what's coming out of Washington right now. Anyway, let's talk about what we are seeing in the futures this morning. To be honest, not a lot. The opening trade is coming up. We'll deal with some of the single stock stories in just a moment. 5 minutes to go. That's next. This is Bloomberg. Friday morning, good morning. We're heading into a long weekend. That probably means quietness. I think people have already decided the weekend has started. So let's talk about yesterday, because yesterday was quite interesting in many ways. We saw European equities rallying into the close. We saw US equities selling into the close. And that is something that we've got to factor into our thinking first thing this morning as we work through the initial stages of the European equity session. How the rest of the day goes, I don't know. We've got not a lot of news to focus on to really act as a catalyst. So that's kind of the history lesson. Let's talk a little bit about what is going to happen in the future. So let's take a look at futures and figure out what the picture there looks like. It's not overly exciting, if I'm being brutally honest. Eurostoxx 50 futures, flat as a pancake. FTSE futures up by 0.2%. Not a lot of excitement there. DAX futures slightly negative. Net, not a lot happening in Europe. And to be honest, US futures aren't painting a particularly exciting story either, Critty. So maybe today we look at some of the single stocks. What have you got?
A couple of individual stocks on our radar. I'm going to start with the banking story because I think that's where my attention and my eye immediately goes. So we'll start from the bottom up of the screen. UniCredit, for example, kicking off legal action against the Italian government today around the conditions imposed on the BPM bid. So they are really doubling down when it comes to that story as well. Michelin is another one that we certainly have our eye on this morning. And that's, of course, the French tire maker that we're keeping a very close eye on, getting an upgrade to a buy from a hold over at Jefferies. We're going to dive into perhaps some of the details there. And, of course, Hexagon and the tech story very much in focus today. But, again, Guy, to your point, light volume, light trading, bracing perhaps for the long weekend, at least in the UK and the US? And
in the US. So two major markets are basically to be out on Monday. That obviously is something you want to think about in terms of positioning going into the weekend. So let's walk you through the open. It is unlikely to be exciting, but I bring you numbers. Here they are. Let's start off and see exactly what is happening with the FTSE. Flat as a pancake. Yep, this is exciting stuff so far. We are going to move on maybe to some of the other markets that may move a little bit more, but I very much doubt it. Is there any news that can stop the CAC and the DAX opening a little earlier than normal? I can't see it this morning, but you never know. In some ways, I'm actually praying for it, because actually some exciting news out of one of those two markets would certainly liven things up a little bit. But no, they do not open. There they go. And it's an exciting open. The CAC is up by 0.2%. The DAX is up by 0.1%. This is blistering stuff being generated by European equity markets this morning. We are, though, as I say, going into a long weekend, so maybe this is slightly understandable. Crini, what are you seeing on the sector story? Anything there?
The sarcasm is really fun this morning. I'll start off with maybe some of the individuals that are actually, I think, moving this market, because it's a little bit of a mixed picture here. I'm looking at 358 stocks in the green, about 160 in the red, and it's not really moving the market much, to your point. But when you look at it from a kind of index perspective, you are starting to see the likes of technology, healthcare, even utility. Some of the more defensive sectors are in the green. Some of the more perhaps cyclical and risky sectors in the red. From an individual stock story, though, I think it's interesting. Deutsche Bank, I've just been flagged as an ex-div this morning. It's actually weighing on the stock 600 the most, down about 1.8%, but again, in the context of that ex-div story as well. But to the upside, I'm seeing some of the tech names, some of the healthcare names. A lot of the names sold off yesterday are in the green today.
Balance is actually quite positive. So I've got 185, 190 up. I got 122 down. So the market does feel broadly more positive this morning than negative. But in terms of where the points are being added and taken off, as you say, some of the ex-divs out of Germany are probably the biggest factor. On a day when ex-divs are the story that you focus on, it probably tells you that actually there's not much else going on either. Novo's a little more positive this morning. Actually, some of the pharma stocks are doing better. So that probably is where the action is. So Novo, Astra, I'm seeing Roche on the screen as well, doing relatively well. Some of the luxury stocks are coming back a little bit. But there's no clearly kind of obvious discernible story that is emanating from this from a sector point of view or a single stock point of view. Novo and Astra doing the heavy lifting in terms of the biggest percentage gains. You've got Thule, Bridgepoint, Iveco and CVC on the upside. Not big moves.
Not big moves. I'll just point to the one on the screen here. You mentioned some of the pharma names. Bayer as well is getting a bid. And I believe our producer this morning had actually flagged this to us for a couple of reasons. There's a report that had Bayer in the footnotes as well coming out of the state. But I'm also seeing headlines this morning out of Dow Jones saying the European Commission decision around some of its drugs that are due for review and potential extensions are also perhaps due for approval. So perhaps a little bit of a double whammy in terms of Bayer. Certainly seeing some heavy volume this morning. Let's get a little bit more perspective on perhaps these broader markets as we struggle to come up with a single stock story. Christian Mueller-Glissman, head of asset allocation research over at Goldman Sachs, joins the program mostly to rescue us, but also for his analysis. Walk us through I'm asking every guest this. What's the next catalyst here? As we're kind of in this holding pattern, what do we look to next?
Yeah, I mean, listen, I think we've been in this fast and furious, sentiment-driven, uncertainty-driven market where the market went from being a bit bullish coming into the year to this extreme bearishness. And I think now we go into data period, and I think we are all seeing that hard-soft data gap, which is still in the data, the biggest since the 70s. So the expectation to some extent is that the hard data will start to crumble. We're waiting for that. We're not seeing it. We are expecting it. And that to some extent gets markets probably then to focus a bit more on the impacts. Is it going to be the consumer? Is it going to be the labor market? Is it going to be selective corporates maybe? But I think we're not going to get much until, probably June, July, where this impact will be felt. So the other thing, the market always can focus on one thing at a time. The other thing the market is very focused on is the bond market. And this idea that you've had the kind of budget bill pass and fiscal concerns are coming back a bit. But it seems that this has moved quite a bit already.
What's so interesting is Guy was touting himself as the British having a British accent and bearish.
You sound cleverer, basically, if you have a British accent and you're a bear. That was the argument that was put to me earlier on this week. I built an entire career around that strategy, so...
I'm not debating it.
I won't say anything.
Yeah, I'm not debating it, but the reason I bring it up is because I feel like sometimes I have a bullish bias as well. And when you're looking at the deficit story, or at least the tax bill story, some of that has been the concerns around the fact that the deficit will widen, and therefore the bond market is freaking out. But the tax bill also includes tax credit extensions. To what extent does that cushion a consumer, an American consumer, and that resilient story that perhaps was in question 2 weeks ago?
Yeah, I mean, I think we're all hoping for that. And there's a certain endogenous element. The equity market will be most important for the consumer because of the wealth effects and the household allocations to equities. So to some extent, if the equity market holds up, that might be even more important than the budget bill. But I would say that the net effect of the tariffs relative to the budget bill, we actually think the net effect is negative. So our economists have done a lot of work on it. So if the tariff rate, the average tariff rate stays at 13, we still think that there's going to be a growth drag. But I think you're right. That's the plan. That's why they pushed it so quickly. I think they want to get that bill in to kind of counterbalance the negative effects and set them up nicely for the midterms.
I mean, I want to sort of maybe return a little bit to the bearish argument here. If we are seeing these drawdown risks normalize, and we're seeing some of the rally risks also normalize since that April Liberation Day, do you think markets are underpricing some kind of macro shock in the second half of the year? I know you've highlighted we're waiting for this hard data to come through.
I think so. I think definitely it's not going to be an easy end of the year. I think the baseline we have is probably a bit like a fat and flat range. I think the growth might drive occasional setbacks. If you don't see those setbacks, the bond market will create a speed limit for equities. So you're a bit more range bound. So you're back to that growth rates tango. We've seen it before, like back and forth between growth and rates. And I think you're right. There's like downside tails. I think they come in particular from the labor market. The market is very nervous about any deterioration in the labor market. They come from profitability, like corporate profitability has been a key driver behind the elevated U.S. equity valuations. So if you see any signs of that changing, I think it will scare investors. Like you heard, obviously, the headlines with Walmart having to absorb the tariffs, etc. I think all of those things will be very closely watched. So you still have that risk. But what we are saying is the volatility reset we've seen is one of the fastest on record. So at this point, rather than market timing aggressively, we would recommend maybe hedging, diversifying selectively, and waiting for the data to give us a more clear direction.
OK, so on that sense, perhaps of a false sense of security that is created by this very fast reset, where do you think investors should be looking for then? And then that question of that sort of diversification, that hedging, where do we go in this environment?
Yeah. I mean, I think most important, the biggest risk in your portfolio is probably equity still. So I think most of our hedges, most of our risk mitigation strategies are very focused on equities currently. We've looked at low volatility stocks, revisiting them maybe as they fall behind. We're looking at selective overlay hedges via options. So I think that's the first port of call. We've also seen quite a bit of interest on rates hedges, where people are worried about the 10-year breaking the 5%, and then the feedback loop go to the whole portfolio. It will hit equities, it will hit fixed income. And in terms of diversification, I think there's a lot of focus on gold because it has a really weird characteristic of protecting you, obviously, from broad risk on, risk off, possibly, but also having this fiscal and this debasement characteristic. And we still know that investors are not happy with their dollar allocations, with their dollar assets. So I think any opportunity to diversify that and reduce that is interesting. So we even had people recently look at emerging markets assets as a diversifier for their dollar exposure, trying to go up in quality in EM local currency debt, which is somewhat defensive, but then get a bit of a benefit in case the dollar weakens. I
mean, you talk about this sort of move away from dollar assets. It's something that we're really familiar with in Asia. It's a real paradigm shift. There's a lot of soul searching going on. But it's also been very painful, these very painful dislocations, what we've seen with the Taiwanese insurers, the Taiwan dollar, that movement in the yuan. So I want to ask about those pockets of risk that you see as we see that move away. How do you think about the contagion effects, for example? How orderly is that unwind going to be?
I don't know. I always feel like when you think about the rebalancing of U.S. assets in global portfolios, it could happen in three ways. Like equities could sell off a lot. bonds could sell off a lot, or the dollar comes down. I actually think the weaker dollar is the least bad. I think for portfolios and for the US consumer and probably for the global economy, to some extent the strong dollar has actually tightened global financial conditions and has arguably been a bit of a cost for the rest of the world. So the weaker dollar is the path of least resistance. It's a quite easy way to rebalance these imbalances. It can be disorderly occasionally if the market gets worried about policy initiatives, if the market starts to see a more stagflationary impact of the tariffs in the US compared to the rest of the world. That could really change things. Obviously, the market is still very focused on monetary policy independence. I think we had that Supreme Court ruling yesterday, which kind of makes firing less likely, but we still will get a new Fed chair. And that new Fed chair will be scrutinized very closely in terms of understanding monetary policy independence, and that matters a lot for the dollar.
What's the pain trade right now? What's the market kind of going to hate? Is it equity selling off, which I think a lot of Americans will be upset about, or is it actually American assets, US equities melting up at this point? I'm kind of wondering what is it that would cause the surprise, the pain trade? What would the market hate right now?
I would say, I think you said it nicely. I think you always go back to what's happened recently. You had S&P down, Treasury down, dollar down being the major concern. So investors try to address it in their portfolio. Yeah. So if you now see the opposite, S&P up, Treasuries up, dollar strong, like a complete reversal, let's say, the tariff rate really has another major leg down and you see a big squeeze. I think that would probably be the pain trade. But just to be clear, it would be painful for the tactical community, but strategically all long US assets. Yeah. So from that perspective, it wouldn't be as painful maybe for a lot of the institutions. And I can tell you, while this US dollar and US asset reallocation is somewhat ongoing, it's early. I think a lot of the clients we speak to, they have done things at the edges.
OK, well, let's follow up on that. How convinced should we be by the Make Europe Great Again argument? Because everybody's talking about reallocating to Europe, or some people are talking about reallocating to Europe. As you say, maybe we're still early in that process. But there's still this kind of nervousness at the back of everybody's brains that we've been told that Europe's great before, and it turned out to not be great. And I'm wondering how much of an impediment that thought process still is in terms of people's thinking.
Yeah, I think there's two narratives here, two motivations. One of them is home bias. So what we've actually seen is the Europeans have been among the strongest buyers of European equities and sellers of US equities. Right. So you just go back home. Yeah. And that can make sense even from a currency perspective because you are managing money for people in euro. You're matching liabilities in euro. And I think that is a very sensible thing to do. Often that's less driven by the fundamentals where people are arguing that it's more about risk management. And it's a true point that just European equities and US equities being less correlated argues, assuming the same risk, for a bit of allocation to Europe, even if there's a bit less return in Europe. Like this, the fallacy that Europe needs to outperform in order to justify allocations to European equities. But there's another thing. What we're currently discussing a lot from a fundamental point of view with clients is you need to look beyond sectors, companies. You need to look at factors. There's a lot of interesting factor-type investment strategies that you can...
Examples?
Sorry?
Examples?
Low volatility is the easiest. The simple low volatility strategy just ranks the stocks by their realized volatility and buys the least volatile. Okay. And we actually found it's a very interesting diversifier when you're late cycle, when you have volatility, and Europe has plenty of that.
You're the second person to come on the programme today and talk about min-vol strategies, and that's quite interesting. Christian, thanks very much indeed. Nice to see you as ever. Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Call 6 looks like this. Not expecting a lot of excitement here, but let's take a look anyway. There you go. Actually, there's a bit of movement. Certainly, we are seeing some movement into the pharma sector this morning. Novo Nordisk on the left-hand side of your screen, certainly popping quite nicely after what has been a tough time, quite a volatile time for that stock. Let's figure out what else is happening. Let's turn to the finance sector. Joe Easton's here with the details.
So we have got some excitement, guys, some rare excitement this morning, as you say. But over at AJ Bell, we're seeing that one up around 7% at the moment on the London-listed investment company, the retail investment firm, saying it did see a pickup in people buying stocks stocks and shares during the volatility, given all of the sell-off and the ups and downs that we saw following the tariff news back in April, and therefore beating expectations on their revenue. Also, the ISA impact, people trying to get their tax benefits in time for the tax year, probably helped with that one. Then we got Frontline. This is oil tankers over in Norway. Looked a little bit light on the net income, as we've got on the bottom of the screen there. Also, the tanker rates coming down a lot, given the decline in oil prices, and also some of the shipping rates generally coming down a little bit weak on that one. Then Games Workshop, which is, of course, tabletop elves and goblins. One that probably doesn't get enough attention, but that one is down. A rare miss for that stock. That stock has rallied so much over the past few years, up around 500% or something like that, and the revenue today actually missing a little bit on some of the high ends of expectations. The Games Workshop recently added to the FTSE 100 as well, but coming down today. Then Hexagon on that M&A scoop from the deals team, saying that the firm looking to sell off their simulation software business, potentially worth a couple of $1 billion according to the report on that one. So a bit of a boost over in Sweden. Remember, that is worth around $30 billion, that company, in terms of market cap. Not a small firm, so worth some focus. Then in terms of tyres, Jefferies upgrading Michelin, as we said earlier, downgrading Continental. Specialist tyres in agriculture and in the aviation space is where the big tyre money is going at the moment, according to Jefferies. So they like that one. I did see Continental slipping as well. And then finally, another broker move, CVC Capital over in Amsterdam. That one gets a buy at Bank of America, which says that concern around private equity exit rates, so not enough private equity deal sales coming through, that is actually overdone now, according to them. So they reckon you should buy CVC Capital today, rising 1.5% in a pretty quiet market over in Amsterdam this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much. He ended there on the private equity story. We're going to continue to bring that conversation to you, this time with the founder and chairperson of European private equity giant EQT. Details of what to come from the Swedish firm, from the Swedish billionaire himself. Next, this is Bloomberg. There's been a big question of American exceptionalism and whether or not that era is over. Well, it turns out the chairman of EQT, the largest private equity firm in Europe, and of course a Swedish billionaire as well, believes that might just be the case. In fact, it's helping him make more progress in the PE space, not only here in Europe, but also in Asia as well. Let's get the take directly from him in this exclusive interview with none other than Conni, Jonsson. Take a listen.
It has been rather favorable for us not being based in the US and being a US firm, because the ones we're competing with is almost exclusively the US firms right now, and they are having some headwinds out in the world for reasons caused by others than themselves. And the flip side of that is that people are looking more for managers that are not based in the US, and maybe to deploy money with GPs that is not US based or US dollar denominated. So it has benefited us, especially in Asia, but I would say also in Europe to some extent.
What do you say to global investors that are looking to invest in Europe, or saying, give me a reason, Conni, give me a reason that Europe will suddenly wake up and catch up to the rest of the world? Is there a reason to be optimistic here?
Well, Europe would never have been able to get organized without getting pressure from somewhere. And now we got pressure from the US, and now we are trying to get organized. So it's clearly so that the understanding of the necessity of change is there. And now we are waiting to see the actions. We see some signs, but there are so many things that needs to change to get Europe back to a position of competitiveness. And it's talked about, and everybody travels around, meets and discusses these kinds of things. But it has to be proven that we also can get into action and create the right regimes, regulations, allowance to consolidation. We need to have one common capital market. We need to have a handful of strong, big, successful European banks. Basically, we have maybe one today in Europe. And those things need to be put in place, and they need to be put in place by the politicians, unfortunately. And that's, of course, it's a bit scary, but we are hopeful that we'll get there. And we're helping them. We are participating in the dialogue around that.
What is the thing that no one's talking about right now? What are we missing? Because we covered a lot.
Yeah, I think this democratization of private equity is an area of concern of mine, because it needs to be done in a very mature and responsible manner, and because it's also so public. You cannot hide anywhere. I think that's one thing. I think the other thing is probably that I'm very skeptical. We have been discussing to do investing in credit, or setting up a credit business. I'm very skeptical towards that, because it's not investing, that's sort of lending money. And that's a completely different business than what we are in. And it's also unregulated. So we have a big gray banking market here. Everybody was pointing at the dangerous gray market in China for many years. Now we have our own gray market here. And that could also lead to mishappenings that will have a negative impact on, not only on us, but also the financial sector and the societies in general. And there the regulators and the politicians are too slow. They are not agile enough, securing that these things doesn't happen. Here I think it's too much greed too fast, and there's too much money at stake for people to exploit it.
Conni Jonsson there, the founder and chairman of EQT. He's got his Jamie Dimon hat on, which I think is fascinating. He's kind of talking about this era of U.S. exceptionalism being over. He's saying it's helping them in Europe, but really he's got his eye on Asia. He's saying that's where the growth prospect is in the private markets. He's also completely throwing cold water on the private credit move. The hottest part in the private markets right now, he's saying it's looking a little sketchy. It's looking like a little bit of a gray area, making the comparison to Asia there as well.
I definitely want a Jamie Dimon hat. That's something that I would like a lot. We can get those made.
You bear a resemblance, I think.
I'm not really sure that's true, if only. Let's turn to other things going on in banking and figure out what is happening this morning. The EU confirming that it will delay bank trading rules by 1 year. This is another delay that we are seeing in terms of bank trading rules. Basically, the Europeans don't want to go before the Americans. Bloomberg's Tom Metcalf joining us around the table this morning. Is that too simplistic a view?
Oh, I like simplistic. No, and I think it's broadly speaking that. You see it in the UK and the EU. So this announcement, effectively confirmation, they delayed it by a year once. They're now delaying it to January 2027.
Yep.
And the idea is they don't want the Deutsche Banks, the BNP Paribas going up with a sort of one hand tied behind their back if they're implementing these stricter capital rules when, the US banks, no one yet really clear what might happen over that side of the Atlantic.
Can we talk about one of the biggest deals that we're keeping an eye on? That's like kind of a green light, red light situation, and that is UniCredit. Walk us through the latest with their Banco BPM bid.
Yeah, I mean, the battle lines, I guess, were already drawn, but today they came very, very clear. So you had a UniCredit statement effectively coming out there and saying, the deal's on pause for 30 days, and what they're using to do that is effectively to take the Italian government to court to see about these conditions that, Rome have imposed on them completing this deal for BPM. So, I mean, look, there's that happening. At the same time, they say they're going to engage with the EU on a review of this sort of golden rule that Rome has. And then at the same time, this was actually yesterday, but BPM have come out and effectively kind of slammed how UniCredit's acting and this whole 30-day delay, saying it's just unacceptable and the deal should be pulled.
Is there a path forward here? And what is that?
I mean, the interesting thing from today, I think, is that UniCredit, aren't backing away. They're saying, look, we're trying to engage. We want to find a way forward. They clearly do want to do the deal if it's possible. But when you read the statement, I mean, the language is pretty fiery. And they go through and talk about this anima bid that BPM have done and effectively say we disagree with the way they sort of disclosed all that. So I wouldn't say it's sort of happy families at the moment.
All right, Bloomberg's Tom Metcalf walking us through some of the banking dynamics in Europe. We thank you so much. From, of course, UniCredit to what's going on in the EU as well. Coming up on the program, we're going to take the pulse from businesses adapting to a new trade reality. HSBC's Vivek Ramachandran joins us next. He's going to walk us through those U.S.-China tensions. Does the shipping data still actually matter? How do you trade these geopolitical pressures? And how much of that pricing power can you actually pass on? I feel like those are the questions that are roaming in everyone's head. Yeah. Maybe he'll give us some answers as well. In the meantime, light volume, light liquidity going into a long weekend in the UK and the US, but yet the equity indices are in the green. Stick with us. This is Bloomberg. Welcome back to the opening trade. We're 30 minutes into today's session, seeing green on the screen across the board. Some extra oomph, I think we're going to call it, in the DAX, higher by about 0.5%. A lot of that has to do with Deutsche Bank, though. Or actually, in contrast to Deutsche Bank, though, that is, of course, one of your biggest downside movers. It is an ex-dividend stock, but one you want to keep an eye on as well. Light volume, light liquidity seems to be the name of the game. Of course, as we wait for that next catalyst, one of them being the geopolitics and the trade policy emanating out of Washington, D.C. It's that topic that's been a major theme at the Qatar Economic Forum in Doha. Take a listen to what some of the guests had to say about those challenges.
Consumers are starting to pull back on their spending, and business owners are starting to push off capital expenditures.
We just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates.
You have a substantial amount of uncertainty in almost every market.
The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment.
I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing.
And so you're getting back to, okay, this is a storm, but we'll get through the storm.
People used to be very U.S. exceptionalist, U.S. And we have seen some shift from U.S. to other countries since the beginning of the year.
I think we should all be very careful. There is too much debt in the system.
We have seen a de-escalation, but we still know that some tariffs need to be negotiated, that we're in a period of pause.
Some of the great guests we've been speaking to at the Qatar Economic Forum in Doha this week, talking about the impact of President Trump's tariffs. Where are we in that story? Well, let's explore it a little bit. ECB President Christine Lagarde warning overnight that international trade will, quote, never be the same again. This was obviously an interview on the sidelines of the G7 finance ministers meeting, which is taking place in Banff, Canada. It comes as HSBC publishes its 2025 Global Trade Pulse survey, which says that over 3/4 of corporates are rethinking their long-term business model as a result of tariffs instability. Joining us now, Vivek Ramachandran, head of Global Trade Solutions at HSBC. So given what your survey is saying, Christine Lagarde is right. Trade will never be the same again. There is a big rethink going on. Is that the right way of thinking about this? And how long does that take?
I think trade has changed already. 65% of clients we've spoken to are already seeing costs go up. So that's happening today. And a third of them are dealing with supply chain challenges and logistical bottlenecks. That said, no one expects the world to go back to where it's going to be. So everyone we've spoken to is planning to reshape their supply chains, look at new markets, or change their business model. Now, trade doesn't change overnight. No. Supply chains are built up over decades. They've been built up to minimize costs, and you can argue they've done that incredibly effectively. Now they need to become resilient, and they need to actually be able to move based on geopolitical concerns. And that's a big concern for companies.
So you're saying you're already seeing effects. How far into this process, though, are we? We're trying to work out when we see the effects of the tariffs, kind of how long does this process start to take to unfold and have a meaningful impact into the data? What guidance can you give us there?
You'll see it today in prices.
Right.
So 65% companies feeling an increase in price. You either pass it on to the consumer, you pass it on to your supplier, or eats it to
we
margins.
saw it in the PMI data.
So we're seeing that today. But most companies are in wait and watch. You would not make a strategic move till you know where the tariffs are going to settle. So while you're hoping for a quick resolution, most companies are preparing for prolonged uncertainty. So I think we won't see fundamental strategic changes for another quarter or two till we see a resolution of where the trade boundaries are set.
Vivek, picking up on that point about passing through those costs, is it too early to get a glance into how that's happening, how companies are divvying that up between the consumers versus taking it on themselves? Is there a lesson to be learned yet?
It depends on the sectors. So sectors with a short production cycle, like tech, consumer, healthcare, we're seeing that today. Sectors with longer production cycles, like energy, utilities, or heavy industrials, is going to take longer. So it depends industry by industry. What we're also seeing is a huge variance across geographies. So we're seeing new trade corridors emerge. India is trading a lot more with Europe and with the US. ASEAN companies with China. So we're going to see new trade flows emerge and new corridors emerge as a consequence, but companies have to become much more agile.
How quickly can we see that reframing or those new channels opening up? I mean, what I'm really asking is how quickly can that actually start to offset some of the other drags that they're seeing when, for example, China can no longer export to the US and so on?
So this year, I think you will start seeing new trade corridors being formed this year. I don't think you'll see supply chains fundamentally reshaping, but you'll see demand behavior changing this year. Supply behavior will take another year or two to happen.
And the sectors where that's most pronounced?
Tech, healthcare, and consumer. That's where we're seeing a lot of it. Services trade, no one talks about, has been exempt from tariffs. But interestingly, services trade can move a lot quicker. It's a lot more agile. So we see companies also evolving and changing their business models to introduce services components because it's much tougher to tariff a service than a good.
How much of the COVID-era playbook has prepared us for this moment?
Not at all, I would say. So what COVID taught you is about blockages in supply chain and finding alternative suppliers. It didn't force you to look at new demand markets. So COVID helped you with supply management. It didn't help you with changing demand. So where do I base my production facility, whether it's closer to the consumer or closer to home? This is a completely new playbook. And which is why I think companies need to be much more agile, but also get partners to help them with that.
So that friendshoring argument that came after COVID, and even in the first Trump policy where the tariff story was happening, where if you're Hasbro, for example, and you want to sell toys in America, you build your production facilities in Mexico. That argument slowed down during the Biden administration. Are you seeing more momentum and more move from some of the folks you're speaking to?
So you look at the hard data, supply chains actually got longer rather than shorter. So instead of producing in the last 7 years, right? So instead of you are moving production closer to home, but effectively it ends up being the assembly that's moving closer to home as opposed to the underlying materials.
Yeah.
So that will have to change, and I think that's where the next 5-10 years we will see new supply chains, we will see new opportunities for companies who seize that.
How does that work though exactly? Because I mean, look, not every raw material is available everywhere. So is that are we shooting for an inevitability? I'm going to say this right. That isn't even possible here.
It depends by industry. I mean, I don't think you can fundamentally reshape what the world of trade looks like, but what you can do is decouple. So companies are looking at China for China, US for US, and you can have new trade corridors emerge. But the underlying raw materials, I agree, but I think the manufacturing can move.
We talked to some of the shippers the other day. Who did we talk to? Maersk. We talked to Maersk and we talked to Hapag-Lloyd. Both were painting a really positive picture about what they've seen post, 2 weeks ago, the China Monday deal, the Monday deal that we got on China and the announcement. How big an impact has that had? Is that sustainable? What are you seeing in your data right now? Just give us a coalface experience of what's going on.
So we saw front-loading before the April announcements.
Yep.
We saw a huge amount of blank sales, so cancelled shipments in the few weeks after that.
Yep.
The trade agreements mean we've seen a spike in the first few weeks of May.
Yep.
So companies are building up inventory on a really short-term basis.
So does that just delay the effect?
That delays the effect.
Right.
So it kicks the can down the road. So till we end up with... it's realistic to assume 10% is going to be the new baseline.
Yep.
And that's a scenario I think most
companies... So when do we get a clean number? When do we... assuming we... stability.
Your guess is as good as ours.
OK, fair enough.
I mean, something that caught my eye as well is that this confidence story, that despite all of this disruption, businesses still have this confidence. I want to ask, what is behind that optimism? And is it overconfidence, or is this a sort of genuine story about resilience?
So what trade does is it meets a consumer demand. Consumer demand is not weakening. Whether it's in the US, arguably China, you're seeing a pickup in consumer demand, and that's what's driving business confidence. But also, I think businesses have realized there is a lot of value to expansion into new markets. UK companies have typically looked at Europe, looking at markets like India and ASEAN. So there are new growth opportunities, and the confidence has been the highest in Indian companies, companies in the Middle East. This is where we're seeing underlying demand and new trade coming in.
What are you telling your clients that you work with in terms of ensuring that possibility? If we're waiting for the actual trade developments to take place over 5-10 years' time, how do you trade that? How do you prepare for that in the interim?
Your strategic plans can no longer be linear. You have to prepare for different scenarios. So agility becomes really, really important.
How do you do that? Give us an example of the solutions you provide.
So what we do is we help you mitigate the risks with finding new buyers, expanding into a new market, finding new supply chains. So in this case, you do three things. The first is you break up your demand into your home market and markets which are core and not core. The second is you look at where you can expand activities. And the third is you partner. So you have to form partnerships to hedge against different scenarios.
The big scenario kind of here, though, isn't that aren't we heading into a world where the US consumes less? So Donald Trump the other day was talking about children buying fewer dolls. You can have, 1 or 2 as opposed to 30. this is the story that we're heading into, which is a US consumer that has got very used to cheap stuff. And you wonder whether or not that cheap stuff is going to be there. And how do you kind of break that addiction to cheap stuff? Is it by changing the dollar narrative? Is it by tariffs? And you wonder ultimately kind of how quickly this works its way through into the system. But there is this kind of... The US has been this kind of dump consumer for the rest of the world for really a long time.
But it's a question of price sensitivity, isn't it? It's because, I mean, this week we've heard from, I'll give you the Nike example because I'm a little obsessed with the story. They put out a conversation in their earnings or the analyst call somewhere where they said that the trainers or sneakers that are worth or sell for about $100, they're going to go up by $5 at most, but only if they are selling at the moment for over $100. But as a consumer, I'm thinking that doesn't make that much of a difference to me, from a $100 pair of shoes to a $105 pair of shoes. And it's that line that's unclear of where that red line is in terms of changing. Okay, well, at 105, I might not change it, but at 150, I might reconsider what I'm buying. And we haven't found that red line yet.
I mean, are companies finding that red? Because it speaks to your point when you're talking about tech, for example, and some of those sort of higher cost sectors. Are companies sort of finally finding those thresholds?
Finding demand elasticity is the biggest challenge for companies. And if consumption were to go down, that's economic slowdown. Right? So I'm not sure that's the outcome that's intended, and hopefully that's not the outcome.
Isn't that what Trump's talking about? That ultimately, when he talks about the consumer consuming less cheap stuff, and that seems to be the kind of the message, the underlying message that is coming out.
Or is it switching to different products? So, so is it either reducing consumption, which is not necessarily a good outcome for the economy, or is it switching to a different product set?
And how do you read it?
And so I think it's the latter that's being expected, because switch to American-made products is obviously the expectation. And I'm not sure how possible that is for the entire suite of products that you've got.
Okay.
You mentioned that this strategy changes sector by sector. Which sector has it the hardest and which sector has it the easiest?
I think services sectors have it the easiest right now. Because by definition, if you're in a tech services sector, your products travel across borders, have not been impacted by tariffs, and that's where we're seeing the most. Short-term consumer goods are probably which are going to get hit the hardest. So you have built up inventory over the short term, but consumers tend to be quite price sensitive in that space.
You wonder whether the dollar's the cheapest way of doing this. You just reduce the value of the dollar, and that makes everything more expensive in America.
Yeah, I mean, that's one obvious way. Yeah. I mean, what do you think is the thing that we're most commonly misunderstanding or missing about the China story when it comes to this whole reshaping of supply chains and tariffs?
So China supplies a little over 30% of what we eat, wear, and consume. That's unlikely to change anytime soon. I think that supply will find new homes potentially, but our reliance as a global economy on Chinese manufacturing is unlikely to change fundamentally anytime soon.
Vivek, masterclass, thank you very much indeed. Really appreciate you stopping by to update us. Vivek Ramachandran, Head of Global Trade Solutions, joining us from HSBC. Coming up, we'll turn to the United States. The White House ordering Harvard to stop international enrollment, escalating its fight with the elite US college. Details on that story next. This is Bloomberg. Welcome back. 46 minutes into the equity market session. Volume is anemic. I've just checked the chart. There's not a lot going on in terms of the volume story, just to kind of put it out there in case you think that I am underplaying what we're seeing on the screen in front of you. The FTSE 100 is outperforming a little bit this morning. You are seeing that because you are seeing some of the oil majors doing relatively well this morning. Oil looks like it's finding some stability. You're also seeing some of the healthcare companies, AstraZeneca, etc., doing relatively well as well this morning, and that, like Astra's, a pretty big weight on the FTSE 100, the biggest weight on the FTSE 100. It's giving that market a little bit of a lift. But this feels like a market on a Friday before a long weekend in the UK and the United States. So there are other things to talk about, Harvard being one of them.
It absolutely is. I mean, look, this is a political story. This is an economic story. This is a financial story. The Trump administration has blocked Harvard University from enrolling international students in a major escalation of its fight with elite American colleges. Now, Harvard President Emeritus Larry Summers blasted the move.
This is vicious. It is illegal. It is unwise. And it is very damaging. Why does it make any sense at all to stop 6,000 enormously talented young people who want to come to the United States to study from having that opportunity.
Larry Summers there, the Harvard president emeritus, among a series of other roles, really blasting the move from the Trump administration. This is, of course, a scary political story in the United States, really chilling and dampening some of the international desire to get an American education, not just in Harvard, but other universities as well. This is also a financial story. Harvard is a $53 billion endowment. You lose the tuition from some of these international students. You have to dip into a pile of money that is largely wrapped up in private equity, long-dated assets, the very sectors that are already feeling pressure right now. I don't even know where to start.
Would you describe Harvard as a forced seller, I guess, is the question?
Yeah.
At some point soon, it may be.
And a trendsetter, because it's not the only, this is the biggest endowment, but certainly not the only one.
There will be others who are looking. In fact, we've already seen that, right? Yale and so on, coming to market, selling debt. The others are looking at other ways. Maybe it's through private markets. But this is a whole recalibration of what's to come. And there will be this sense of, even if their hand is not forced in the way that Harvard's has been, they have to start preparing.
Is this a zero-sum game? Is this also good news for other international universities? Somebody points out this morning, Oxford and Cambridge. Are we going to see extra demand coming through for other elite universities around the world? You're already starting to see, actually, even US citizens talking about maybe looking to study internationally because of what is happening around the US universities right now and the pressure that is on them, not just with this, but with other issues as well, maybe shifting the focus to, therefore, studying elsewhere. And you do wonder, therefore, whether Imperial, Oxford, Cambridge, other European universities do better as a result of what is happening here. That could be a spillover effect.
I mean, I think when it comes to China and Asian students, you're already seeing that, actually. Yeah. You know, the last couple of years, not least just because of US-China tensions, and, of course, the way that the US presented in Chinese news, often highlighting things like issues of violence and crime and so on. We've already seen this shift away from some of those US institutions. So I think what's happening at Harvard is only going to reinforce a lot of, some of them are stereotypes, but a lot of those perceptions. Longer term, US isn't somewhere that you can actually go and build a life. That's the other concern for international students, particularly when you're thinking about coming from China. It's not just about getting the accreditation and necessarily going home immediately. They're thinking about starting their careers. And so if the US is no longer that sort of haven that it once was, it was no longer that opportunity, that's a whole mindset shift.
It's a ticket. It was a ticket. It's maybe no longer a ticket. OK. Let's talk about we're done with this week. Next week is going to be shortened, so we're going to move on and talk a little bit about...
It's official. You've declared it.
It's 8:50 in the morning. Nothing's happening. I think we can move on. The weather outside looks fantastic. Long weekend coming up. We'll get on to the sport in just a moment. But let's talk about what is happening next week. Monday closed, UK and the United States. There's a few things happening next week. US durable goods, I think, will be interesting. FOMC minutes also will be worth paying attention to. We've got, actually, holidays at the back end for Europe. So that's going to be a factor you also want to fold into your thinking as well. US GDP, you get the UMich final print. Like the UMich data on its initial print is quite interesting. I'm not sure how much attention we'll pay on the final print. What's Valerie Totel going to be looking for next week?
Well, look, there's not a lot of action. There wasn't a lot of data action this week either. And I think in the lack of news, we tend to be focused on the politics coming out of Washington. But I, for one, am just kind of, shocked at how well the Treasury market has performed this week. Yes, we had yields rise. But look, we had the Moody's downgrade to deal with, and then this tax bill being passed in Congress. And take a look at 30-year yields. They're, 6 basis points higher on the week? I mean, I think that's kind of incredible. We opened up at 4.95. Yeah. We're below 5.02 at the moment.
Valerie's glass is very much half full.
I love it. I love it. She's usually here warning about the deficit and the end of the world, and this is a nice change of pace.
But look, I think this is a decent signal, right? I think for many people, the bear case for the equity market was a bond market blow-up, was a yield surge that really dented companies' profitability. And frankly, we've had plenty of catalysts, but the market hasn't had this big bond market blow-up. And I'm scratching my head thinking, when could we get that blow up? And if it doesn't come soon, we're, set for an equity market rally. I know you guys have been talking with people on the show this morning about how if the U.S. data does turn, we might not see it till the end of the summer, talking about end of July, August, maybe even September until we start to see, this air pocket people have talked about because of the tariff fight. But hey, I mean, we could easily visit all-time highs in the equity market before we hit that.
The case for the equity rally. Where should we be looking? When do you think we'll start first sort of seeing those signs?
Look, I mean, I do think there is a risk. Even today, we see a melt up in the equity market as people realize that these yields, didn't puke this week, frankly. We didn't reach cycle highs in the 30-year, and now we can start thinking about catalysts the other direction. Maybe we get the Bank of Japan paring back its QT. Maybe they're reassessing their buckets and buy long end JGBs. Maybe you get the U.S. administration talking about relaxing bank capital rules. We've been talking again and again about this SLR reform that could possibly make it easier for U.S. banks to hold treasuries. Right now they have a risk weighting. If they reduce that risk weighting, there's another big buyer of treasuries entering the market. So, with the bull case for the bond market, that is kind of hand in hand with bull case for the equity market.
So 24 hours ago, we had this conversation around the concerns, but the same concerns still are there, even if it doesn't seem to be digestible, which is there's excess supply hitting the market. Who's going to absorb that? If there is this kind of liquidation, we were just talking about it from a Harvard, from an endowment perspective, but from foreign governments as well. Can a bond market, can Wall Street handle that? Is that still a concern 24 hours later?
So it was more of a concern, I think, when we were penciling in an economic downturn in the U.S. Because what happens when the U.S. enters a recession? Normally debt to GDP rises. There is extra government spending because of automatic stabilizers. But if the U.S. economy is juiced by this extra fiscal spending and we don't get that economic downturn, I'm really wondering, when the next catalyst for the bond market is going to come, quite frankly. I mean, yes, we know that Treasury market is climbing in size. We were talking yesterday about the size of the U.S. Treasury market. It's going to reach $30 trillion this year, likely to be added and compounded to that because of this government spending. But the market is adjusting to that quite well. I know we were talking, Guy, about maybe this is going to be the reverse. So instead of a U.S. recession we're worried about, the U.S. economy does okay, maybe even picks up, and we see the Fed hiking. Maybe that be the bond market catalyst for yields shooting higher.
Things we don't expect.
I think you two are jinxing this market. You're like nothing's happening, everything's okay.
I've got to do that.
You absolutely have to. And as a journalist, it feels like you have an obligation. Of course, we will be speaking to Scott Bessent, the U.S. Treasury Secretary, upon his return from the G7. You will not want to miss that conversation at about 4:30 p.m. UK time.
I have a theory that Valerie is in such a good mood because she went to the flash show.
That was beautiful. Always puts you in a chipper mood to smell all the roses.
Yep, absolutely. Been quite literally smelling the roses. The Chelsea Flower Show is on. Everybody's kind of very excited about that in London. The weekend looks great. People are still going. I think my wife's going tonight. Maybe she'll be in a great mood afterwards. We'll see. Come home with some plants, maybe. Anyway, International Africa Festival held in Germany. We're looking forward to that. The world's most boring Grand Prix, the Monaco Grand Prix, is going to be taking place as well. Beautiful, but quite dull, in my view. Premier League is going to be concluding as well. We already know what's going to be happening there. The Chelsea Flower Show. The most exciting event this weekend is the Coopers Hill Cheese Rolling Festival.
I urge everyone to look at YouTube videos of this. I found it quite shocking when I had to look it up yesterday.
Yeah.
Rebecca, have you ever
this is the
all
event,
over the place.
This is the event in Gloucestershire. Yeah, do not go to A&E anywhere near this.
If there's one thing that could ever persuade me to move back to the UK, it would be to see men chasing after a 100-mile roll of cheese down the hill. This is when we shine.
This is where the UK stands out. Yeah. The Chelsea. Flowers and cheese. Quite the weekend. Though I suspect Monaco is going to take the story this weekend. That wraps things up. We're kind of nearly done. I know Val actually wants to talk about the AI device that OpenAI.
Oh, yeah. I mean, come on, ChatGPT becoming a hardware device? I'm really excited. They're going to reinvent what it means to, have a computer. We're going to have a Tamagotchi.
What do you say, Tamagotchi?
ChatGPT friend.
Friends.
Rebecca, it's been great to see you. Thanks for stopping by to see us. It's been an absolute pleasure. We'll look forward to seeing you next time you are in London. That wraps things up for the opening trade. Francine is not here today, so I will be taking you through the next hour. The Pulse is coming up next. This is Bloomberg.